Hello, and thank you for joining our webinar today. I want to welcome everyone to our presentation, Tax Cut and Jobs Act for Service Businesses, What Professional Practitioners Need to Know for 2018 and Beyond. This is part 4 in our 4-part series. If you missed part 1 on individuals, part 2 on businesses, or part 3 on real estate, you are invited to visit our website, www.rcthornton.com, and watch the recordings from our speaker series page. This webinar will also be posted to our website within 24 hours of this presentation. If you would like to sponsor one of these webinars at no cost for your colleagues or with your trade association, please call our office for details. It is free, and we would love to work with you on your specific topic of interest for your business. Today's speaker is Chuck Thornton of RC Thornton & Associates. Chuck is a CPA who specializes in tax planning, compliance, and tax representation before governmental authorities. Chuck has lectured locally and nationally on topics such as tax law, asset projections, and strategic tax planning. He works with many practitioners in areas of taxation. Both the American Institute of Certified Public Accountants and the Arizona Society of Certified Public Accountants have honored Chuck as the Speaker of the Year. Please email your questions to Chuck at rcthornton.com. If they are not answered at the end of this presentation, we will get back to you via email. So without further delay, I will go ahead and turn this over to Chuck Thornton.
Well, thank you, Kit, and good morning to all you folks out there who are interested in taxation as far as service businesses are concerned. Now, I can tell from our little dialogue box we have here that a lot of people have been to all 4 of our presentations, so thanks for hanging in there. And I realize that if you have been doing that, there's a little bit of redundancy here. So there's a little bit of redundancy in the business one we did, the one we did for real estate, and the one we're doing for right now, which is for the service providers. Now, by the way, not everyone there is necessarily looking at the slides on the screen. We did make the slides available to you before then, and if you happen to be just looking at the hard copy, to help you out when we go to the next page, you'll notice it's down at the bottom left hand. I'll just simply indicate to go ahead and I'll say page such. Now, let's take a look at our little copyright notice here. As you can guess, this took quite a bit of time to put together. I found myself being more busy in January than I thought I would be putting these together. The reason for that is that when I first started this project, following the tax law changes and what came out, the only thing that was available was the Act, which is a mumbo jumbo of code sections, and the committee reports. A lot of stuff was starting to come out on the internet, but you always wonder what's on the internet, how accurate it is or not. I detected some things were or were not, but now some, I think, credible source of editorial commentary is starting to come out. And so I try to update it with any of those ideas, but I think we'll see more and more things being posed that would be useful in the future. So let's go to slide 4, please. Okay, here's what we're going to talk about. Since we're really addressing service businesses, and when we think of service businesses, we think of doctors, lawyers, accountants, you know, those type of architects, engineers, and things like that. That's our tendency to what we think it is. Now, I'm going to define this later because some of the ones I threw in there are not subject to this law, but you'll have to stay tuned to find out which ones they are. But right off the bat, I think everyone by now has heard that if you are a C corporation, you can be taxed at 21%. And that certainly sounds pretty interesting. And I've already had, and I knew I would have this question, why don't I just go back to a C corporation? In fact, we, over the years, have gotten most of our clients out of the C corporations for a variety of double tax reasons, and for the qualified personal service corporations, the high tax brackets they would have, and so on. And I'm going to share with you and show you that maybe going back to a C is not the way to go. Then we're talking about the new 20% pass-through deduction for the people who have been in the last couple seminars. A little bit of this be redundant, but new twist when we get into people who are personal service businesses. The bad news is you might not be eligible for this, and the good news is you might be eligible for it. We'll have to talk about how that might work. Limitations for specified service businesses, and then we'll wrap up with some ideas on how you might apply this. So let's go to slide 5. Okay, right off the bat, corporations, they can be state form legal, they can be an S or remain a C corporation, there can be entity election. So back in the older days, you formed a corporation, and if you just formed your corporation, did nothing else, you were a C corporation. Then they came along and said if you do an election, you could elect to basically be an S corporation. And then more recent probably being defined as 10 years ago, the entities, the one person, two person LLCs that became in favor, there was all sorts of things you had to do to make elections. And finally, they just said, why don't we make this easy? If you are a LLC, or even a partnership, and you want to elect to be treated like a corporation, and if you would like to go further and be treated like an S corporation, basically just fill in this one 2-page form and you could do that. There's an advantage to doing that. If you are an LLC, you have certain state protections at the issues for the shareholders, whereas in the corporation you didn't have the same rights. Very briefly, if someone sued one of the doctors, for instance, and got a judgment, they couldn't get the LLC interest, but they might be able to get some type of interest in a C corporation. So nice solution, form an LLC, go ahead and make the election be treated like a corporation. For tax purpose, be an S, but you're still getting the state protection. So in more recent entities that have been formed over the years, we've been going that route, an entity election with an LLC. Okay, so that's just a little overview of the corporations. Let's look at 6. Okay, pluses or negatives, individual at lower tax rates, individual rates. This would not be for professional service corporations. So a reason that some people wanted to be a C corporation was because they got lower rates. For the qualified personal service businesses, which many of the people who are listening to this presentation, I'm presuming you are in these service businesses, that was not even true. About the only thing that was true back then being 10 years ago, was you could get some deductions for medical insurance, as an example, and that has been eroded. Deductions for disability, that was questionable whether you wanted to do that. There were a few things there, all of which the benefits of those have pretty much gone away. So now you go to the S corporation, you have the income passes through, sometimes at initially a higher rate than would have been in that 15% rate that I was talking about. Again, it would have been higher for the qualified professional businesses. No double tax, possible FICA savings, and no built-in gains tax. In fact, I would be inclined to say this, about the only type of service practices that I would see now that might be still a C corporation is they were formed 20 years ago, and they have had a variety of issues where converting from a C to an S was difficult to do, so they kind of had to live with a C corporation. And of course, those C corporations back then did have more benefits than they do now. So most, if not all, of our service businesses at this point are in S corporations or LLCs that we made elections for. Okay, 7, please. So anyway, I talked again about the lower rates. We were saying, why not make all the entities C corporations? I'm going to go quickly over this because I know lots of people have seen it. And those lower rates, basically back then, the qualified personal service businesses were being taxed at 35%. All right, slide 8, please. Okay, I just want to give you an idea. I'm going to say if you want it to be a C corporation, the tax rate, yes, even for doctors and professional services, would now be 21% because that's the highest rate. So if someone made $1,000, let's say, just to make my numbers easy, and you decide to be a C corporation, yes, there you go, $210 worth of taxes. The net after-tax money that's left in the corporation is $790. Now, depending on what your income level is, and they can go up to about 37%, one does not have to be a rocket scientist to figure out that that rate is in almost all cases for people who are in the categories we're talking about, is still going to be lower than what the individual is. However, now you got $790 cash in the business, and I have yet to see anyone who just loves to have cash sitting around in the business. And so the question becomes is that how do we get the cash out of the business? Well, one could say take it out as wages, and assuming there's no other related problems, you just paid payroll taxes on that, as an example. But if you take a look at this, the classic way of doing it is you would pay it out as a dividend. So now the shareholder would pay $190 on that, and the result would be $600. And now when you look at this, getting the money out of a corporation could be effectively a 40% tax bracket for this shareholder who's in the 24% bracket, versus had he been in the sub S bracket, it would have been 24% right off. So what I'm kind of getting to is don't be lured into thinking converting back to a C corporation is good because of these 20% rates. Okay, next slide, please. Okay, we're on 9, by the way, for the people who are following us on the paper copies. Here's a couple other reasons not to be a C corporation. Now, I really want to just nail this down because I'm starting to be asked, and that's fine. I'm glad to answer, but I want people to get the concept. In order to avoid the double tax, what I did not mention with that $1,000 example is the practitioner would then have to take out higher salary than would be ordinary, so there's no profits left in the business. So if your goal is to take the money out of the business and use it for your whatever your personal reasons are, the only way you're going to get it out of the C corporation is take more salary. And so let's just assume now that there's a doctor, okay, whose salary available money to him is $1 million. That's what it takes to kind of zero out his corporation and walk away with the cash in his pocket. And someone has told him, well, you don't want to pay dividends, so what we're going to do is just have you simply take it out of salary. And we'll assume there is no discussion here about what is reasonable compensation. When you get over the FICA base, which changes every year, I think it's 127,000 this year, but I could be off a little bit. Basically, what happens is that you have a Medicare tax that kicks in, and that's 3.8%. When I say Medicare tax, that's been around forever. I think it came in around the Clinton era. It used to be on the first $125,000 worth of income when the FICA bases were in the 70. And someone finally said, you know, this is so cool. Why don't we just simply have everyone with wages pay 3.8%? Now, what's really happening is the employer is paying 1/2 of that, and you as the employer paying 1/2 of that. But if you own the entity or you're a partner in the entity, let's face it, the economics is you are paying both of them. So that's 3.8. And then after your wages are over 250, there's another 9%, which is kind of a high wage earner tax that came out with the Obama regimen. And so you really come up with, if I'm doing my math right, a 4.7. So if I may, let's just say there's a 5% tax on basically taking money as a wage category versus just letting it come through your subchapter S as income from there. So if you could reduce the doctor's wages by $600 or $600,000, and by the way, I'm making no judgment call here on what's reasonable compensation, because that's probably another 15-minute presentation on its own. But let's assume you could reduce them by $600. $600,000 by 5% would be $30,000. So therefore, yes, even though I pulled all the money out and I got the same income tax rate that I would have gotten had it been sub S, I have avoided the regimen of a lot of payroll taxes. And here's a case of $30,000. You know, if it's $60,000, you could do the math. You can see there's some savings there to be had. And you just can't do this with a C corporation. You're going to have to pay out the full salaries. 10, please. So you could say, I'm already in the C corporation. We've already wrestled with this probably with just every client we deal with right now, and we've already dealt with it. But you have to be cautious if you convert from a C to an S. If I got you sold on this concept, then there's another thing called a built-in gains tax. I'm not going to get into it, but basically what it says is your receivables could be still taxed at the C corporate rate and then tax to you again. And so there's gyrations you have to go through, but it's just not the flipping of a switch, doing an S election, and then not having to deal with a built-in gain. So there's some cleverness that goes in with how you're going to avoid the double tax on your receivables. 11, please. Okay, so now that I think I've got you convinced that you want to be a pass-through entity, meaning the income gets taxed to you individually, either through an S corporation or partnership, if you don't want to go that route, or even proprietorship. Basically, what you're going to get is a 20% deduction of your qualified business income. If you're a partner, it's going to be somewhat your K1 profit. The reason I say somewhat is, as anything else, there are some gyrations to it. But for our discussions, let's just say it's your share of profit coming from the qualified business income. So as a starter, if your share of profits coming from your business is $100,000, you get a deduction for 20%. If you're in a 33% tax rate, you save $6,600. So just do some math. Keep on saying it's the 20% deduction, or the new buzzword is Section 199A, which is a new code section in the Internal Revenue Code. Okay, sounding interesting so far. Let's go to 12. So qualified business income is a new term, and now here's where the bad news comes in. Qualified business income means income from any trade or business, so CPAs, manufacturers, lawyers, perhaps even real estate. If you stop right there, it means any trade or business, period, then we would all be able to join in on this one. It says other than a specified service, trade, or business, and it's a trade or business, and if you have W-2 income, your W-2 income doesn't count. There's some technical reasons why, but just accept if you have a W-2, you're not going to get a 20% deduction on that. So what components are not part of a QBI must be associated with conduct of trade or business. It could apply to real estate, but if you have triple net leases, that may not be considered a trade or business. And this may be important for some of the discussions that we're going to have a little later on. It does not effectively include investment income. So if you had some type of portfolio in your partnership and it was kicking out capital gains and dividends and interest, that portion of it would not be includable in QBI. That's why I was saying it's kind of like your taxable income, but there's a few exceptions. And does not include guaranteed payments from partnerships. Guaranteed payments from partnerships is if you have agreed in your partnership to get a certain amount of dollar amount for your services, that's treated just as though it was a W-2. And so therefore, there's an advantage here in some cases for people not to have guaranteed payments from a partnership. Okay, big opportunities for partnerships, but I really want to start focusing on this specified service, trade, or business because that's what this presentation is about. Okay, 13, please. So what is a specified service, trade, or business? And this is going to become interesting as this thing evolves. The irony of this whole thing is that engineers and architects are excluded from this, which means that those guys got in, and basically, I guess someone lobbied against this because this was a kind of a last-minute thing that they were talking about when these laws were being passed. And I suppose some of the exercise is, well, engineers and architects basically help build the buildings of America or something, and so let's give them a break. Again, I think it's more of a lobbying thing is what happened here. It says the performance of services in the field of health, law, accounting, so medical people, doctors, lawyers, accounting, me, okay, actuarial science, those would be people who do your pension work typically. They've even added a little bit more than what's historically been there. Performing arts, so people who are actors and try to incorporate, they're not going to get 20%. Consulting, athletics, financial service brokers, and other trade or business where the reputation or skill of one or more employees. I won't get into drilling down to those other ones there. They're there. I think my focus here is more health, law, accounting, maybe actuarial services. That's where probably most of the people clearly are going to have an issue here. It will not apply under certain income ranges. I'm going to introduce you here shortly to what's called a phase out. So even if you're in one of these health, law, accounting, actuarial sciences, If your taxable income is less than a certain amount, I'm going to keep that as a secret for you here in a moment, but if it's less than a certain amount, then you're just in the same category as manufacturers and you can take your 20% deduction. And so that's going to mean that people who might be somewhere in that range of that taxable income might want to undertake some strategies to make sure they stay under. We'll talk about those strategies in a moment. What is the meaning of services performed in the field of health? Now, for technical people out there, I know I got a couple lawyers listening in. The Act, that's the law, refers to Section 1202, which has to do with qualified businesses eligible for a small business exemption if you sell the stock. That's what that's about. But it also refers and even cites Regulation 1.448. Again, why is that important for the technical people? They have been wrestling with qualified personal service corporations, the inability to do anything with the lower tax bracket. It had to do with cash basis accounting, all of which is not relevant other than for us listening today, that the committee reports, which are very persuasive, refer to 1.448. And so I thought, why don't I go ahead and look it up and put a quote here? It says, for purposes of paragraph E4IA of this section, here we go, I've underlined it, the performance of services in the field of health means the provision of medical services by physicians, nurses, dentists, and similar health care physicians. So you might have a physician's assistant, I think would fall in that. Now, I'm just going to throw this out because you're going to see where I'm going with this in a moment. Does that include the person who does billing for your firm? Does that the person who does the scheduling? Does it necessarily include the use of the equipment? And so I'm going to throw out some concepts here, but notice here it says it seems to nail it down to people who have licenses, physicians, nurses, dentists, and similar healthcare professionals. Now, by the way, we may have lawyers out there, we may have accountants out there. It seems the theme of someone who's licensed providing the services seems to be the theme here. Now, it does clearly say that under 448 for healthcare services. It does not clearly say that for lawyers and people like us, accountants and actuarial. But to me, it's instructive if you want to develop some concepts. So let's go back to, you're not going to get this deduction, this 20% deduction, for a service business, which for our discussions is health, law, accounting, actuarial. The remaining list is up there if you want to look at it, unless your taxable income is under a certain amount. And then I am throwing out the concept of, so what does performance of services in health, law, accounting, and actuarial, and who does it pertain to, and how might that be relevant? So stay tuned as we're discussing this a little bit more. Okay, 14. Okay, QBI starts with taxable income, excludes investment income, and basically it's deduction of 20% of qualified income, hence not foreign sources. And once your taxable wages exceed, your taxable income exceeds 415, the deduction is further limited to 50% of wages or 25% of wages plus 2.5% of unadjusted basis. For folks who listened in Tuesday, we focused on this phrase 2.5% of unadjusted basis of property, because that might be your ticket to be able to using this with some rental properties, especially if you're renting to your practice. I can't spend a lot of time on that, but recall that Kit said this is recorded and you could go back, and if you happen to have a practice or you have real estate and you're one of these service things, you might want to go back and listen to that, because I do spend a little bit more time on that one. Slide 15, please. Okay, there's phase-out rules. Here we are. If your taxable income is less than $315,000, you notice this is taxable income. It's not wages. You could have, or income. You could have $1 million income coming through the practice. It's the taxable income that puts the brakes on the whole thing. And so it says if your taxable income is less than $315,000, there's no distinction on whether you're a service business or not. If your taxable income is $315,000 or more, but less than $415,000, it's phased out. So if you're a service provider, other than engineer or architect, and your taxable income is over $415,000, after all the strategies and everything that we've done, at least with reference to your practice, your service businesses, you're not going to get to apply a 20% against that. It does not mean, though, that if you happen to have other activities, maybe you're in business with someone else and it's not a service business, or going back to that real estate example, it does not mean that you can't get it for real estate purposes. You're just not going to get that 20% applied to your share of the income coming from the practice. So if you're thinking and running ahead with this idea, I'm already setting a few concepts here for you. Let's go to 16. Okay, here's an example, formula example, the phase-out rule. I just made this up. You'll see that it's 1 minus basically taxable income minus 315 over $100,000 times QPI times 20%. I had to sit and think about that formula for a while. I don't expect you to do it, but if you look at the slides later on, you kind of want to remember how it worked. There you go. Here's an example. Assume taxable income is 365. In other words, after everything you've done, you had $365,000 worth of taxable income. You had qualified business income from your practice of $300,000. So you can see you have other stuff going on your tax return besides the income of just the $300,000. The normal deduction would have been 20% times $300,000 or $60,000, but your phase out basically says that you're right in the middle of that phase out. You notice that's phase out 315 to 415 is $100,000. So you're only going to be able to get 50% of the 60,000, at least with reference to that particular practice. Again, don't forget, you might have real estate and stuff, and just the fact that you are a qualified service business doesn't mean that you've tainted anything else that you're involved in. 17. Okay, so example for a non-qualified, I just want to, people have already seen this if they watch the other ones, but I just want to show you the differences. Here's a person's taxable income is 176. He takes 20% times this qualified amount is $30,000. His limit's 35.2, so he gets a 30,000. But I suppose his tax was 125, his deduction would be limited to 25. The result would be the same for a service provider. So I went quickly on that, but you can see if you're a service provider and your taxable, not your practice income, but your taxable income is less than 315, you're home free. If it is between 315 and 415, you're going to have some phase out. But don't forget, you may have other activities going on and different things that are not service businesses, and you're still eligible for that. 18. Okay, here's an example of a taxable income over $415,000 for a non-service provider. I think what we're going to do is we are not going to go through this one. You can come back and look at this if you like, but the point I keep on getting to is that your taxable income for your non-service providers is not necessarily checked out because you're not a service provider. But if you look down at the bottom, I show you some things about wages and unadjusted basis of the assets, which would be not relevant in this case if you're a qualified service business. Okay, 19. So here's some strategies. Can you reduce your practice income to get your taxable income below the 315 to 415? Remember, it's the taxable income that drives this problem. It's not the amount of practice income that you have. And so can you, first of all, I could reduce my net taxable income by reducing my practice income. So you might consider, and I'm finding dentist example, I identified one the other day, where the taxable income's coming in around, I don't think it was 470, but it was around 435. And just at first blush, that was the end of the story, no 20% deduction. But if you take a look, you find out that they don't really have a very hearty, very beefy defined benefit or retirement plan. And typically the people who are more mature in their practices are usually older, 45, 50, 60, whatever. And as you get older, you can actually get a heartier deduction in your pension plan. Now, this is not a discussion about pension plans, but a lot of people don't max them out for themselves because they're satisfied with the amounts they put in there. There are possibilities that you're going to have to put in more for employees, so the demographics of your group is important. But for folks that are somewhere in this range of 315 to maybe $500,000, considering a more hearty retirement plan, more beefy, it's at least worthwhile to go get an analysis done and say, show me how I could get a large deduction and how much more is this going to cost me from a point of view of the employees. And you might look at that and you say, now on top of that, I'm going to pick up a 20% deduction of whatever my net practice income is, and it may now make it worthwhile for you to consider a more beefy pension plan, whereas in the past maybe you kind of rejected going any further than you had. So all this is economics. If getting into a beefier pension plan means that you're going to pay another $50,000, $60,000 for your employees, well, I don't know if the 20% deduction in your practice is going to make up the difference if you weren't willing to do that to begin with. So, in fact, this and all examples I'm going to give you, you always got to take a look at it from a economic point of view. Is this going to make sense? You might consider oil and gas investments. They give you initial upfront deductions. Again, I'm not trying to give you investment advice. You have to decide whether those are good in themselves. But again, I'm working on reducing my income. I'm also going to be looking at how to increase my deductions, but I'm looking to reduce my income or increase my deductions anywhere along the board that it creates my taxable income. That would not be part of your practice, but remember, it's your taxable income that drives this consideration. Going back to the corporation, maybe I do some bonus and Section 179 expenses if I'm expanding, if I'm putting in new equipment. Maybe I consider doing a cost seg study, which we talked about in our last presentation. It depends on what your situation is. It's like we're circling the wagons here, and we're trying to figure out where is the places that we can reduce income in your practice and all the way down through your taxable income, or is there any way we can increase your expenses? And you might find out that you can't get this every year. Maybe 1 year you are close into this area that you say, let's prepay some heavy expenses for this year. Maybe you pay rent for 6 months as an example, and you get the deduction this year, driving on your taxable income, knowing very well that next year the rent you didn't have to pay is going to inflate your income. But maybe we get this once every other year for simple planning strategies that has not caused you to change your life on anything. The pension plan, you're changing your life a little bit. Some of these other ideas, quite frankly, it's just easy things to do, and maybe you can get some of it. So part of this is on your strategies is cost benefit. Is it worth it to do it to chase the 20%? Sometimes there's some simple strategies that will work, and sometimes it may not be worth it for you. Let's look at 20. Now, this might be for more beefy practices, larger practices. You're going to have to, this is an area where I would challenge that in the analysis, you got to take a look at cost benefit. And by the way, keep in consideration, all these laws are temporary until 2025, just like the Bush. He had a 10-year, this is a 7-year law because of the budget reconciliation. You may do these things and then they're 2026, you can't get this 20% anymore, or you might get the Progressive Party gets in control of things before then and changes his back. So there's a little risk looming there in terms of whether you're going to restructure things. So if you have a building in your practice, you might consider spinning it out. I'm not getting into the taxation aspects of it. However, keep in mind that maybe not having your building in your practice is not a bad asset protection strategy anyhow. Absent this law, this might be the time to take a look at it. You might spin out your practice equipment and rent it back. Remember, I said that just because you're a practice doesn't mean that there's other income sources you can have that is not part of the practice. So if I could spin out the buildings and then I could pay rent to myself, well, maybe I still haven't accomplished anything at my practice level. The income's too high, but I've now created another source of income called rents, and now maybe there is a 20%. And my business purpose may be is that I really would like to have some asset protection. Some people put their practices and they split them up. They have a practice that's pretty much the doctors, the nurses, the practitioners, and then the equipment. In fact, a lot of support organization, some people call it management organizations, managed by a non-licensed practice. You might spin out your non-professional employees and you're effectively creating a support organization. Now, from an asset protection point of view, absent this rule, this may not have been a bad idea anyhow. There are, I know for the medical people, some rules about sharing your fees, and so therefore the compensation that you pay is subject to reasonable scrutiny, so it doesn't look like you're sharing your medical fees, and I think that's called Stark, and there's some ethics thing in the, I forget what it was, there was an article on this I was looking at. So you do have to be careful of that. But the thinking on this is coming from the concept of having a management company for your practice has been around for a while. They have wrestled with the issue of how much can you pay, so that's not basically splitting fees. It enables you in those management companies to bring in non-licensed individuals, whereas if it was all rolled up in your practice, everyone has to be a licensed individual. It does open up the door for some other interesting opportunities that existed even before this law came out. But it may open up the opportunities for the 20%, at least at the management company level. Consider the cost benefit on this. You know, it may be as we with our clients go through the analysis, or you, if we're not a service to you, whatever your CPA is, you may go through the analysis and say, this isn't worth it. The asset protection is not something that I was interested in. Or you might say, I can do something with asset protection. I can get other people involved in the practice that are not necessarily licensed individuals. There's an analysis of cost benefit. Okay, slide 21, please. Okay, so anyway, some other ideas just going down the route, anything to reduce taxable income, tax-free bonds, annuities. I mean, a lot of times people are negative about annuities, but there's an opportunity that you can put a portfolio into an annuity with very low charges and all that income, and gain is not hitting your tax return. REITs, they can be nice in that if they are the tax-sheltered ones, tax-sheltered meaning that they're investing in businesses, not businesses, real estate, and the depreciation they're taking on is sheltering the income. Hence, it's sheltering your cash distributions. Hence, it's reducing your income. There may be a place there. Oil and gas we mentioned, and one or two others that I think could be kind of fun here. Charitable gifts. Sometimes people are very heavy donors, and charity deductions are still deductible. Now, it may be that this is an every other year event. It may be that you say, I'll get the 20% this year, but I can't get it next year because I'm flipping my deductions. You could take 2 or 3 years levels worth of your contributions and put them into a donor advised fund. And once you put in a donor advised fund, you get your deduction right there on the spot. And then what you can do is you can advise, you can suggest to the organization who you want the distributions to be made to. They almost always adhere to your request. And we are going to have a speaker on donor advised funds coming up here probably within the next month. You might want to listen to that. We'll send that information out. That'll be another person that we've asked to come and actually does this for their living, to tell you the truth. So front loading your charitable contributions, if I could put $100,000 in addition to what my normal contributions are in 1 year, maybe I reduce my taxable income down to where I get my 20% on top of that, and then I just simply have my donor advised fund make the contributions next year. Maybe I don't get my 20% deduction next year because my taxable income went back up. Increase debt in your practice. When you're acquiring your equipment, you might consider more debt to get an interest instead of basically doing equity financing, which from a financial planning point of view, the less debt seems to be the better. But in this case, maybe pulling equity out of your business and debt financing equipment might create more deductions also. Again, that's just a piecemeal of things. Strategy is, how do I reduce my income flowing all the way from the entity all the way down to my taxable income, or how do I increase my expenses all the way from my practice all the way flowing back down to my taxable income. So in some cases, you might get yourself surprisingly under the 315 when you might say, well, I'm hitting 500 or 600 by just playing your numbers back and forth each year without a lot of hassle, quite frankly. All right, slide 22. I just want to remind you that the cost recovery, which is bonus depreciation, starting in September of 27 to 2022, you get 100%. No, not for cars, by the way, but basically for equipment. So if you are at the end of the year, people say, should I buy equipment? Do we buy it this year, next year? That question could be in conjunction with the issue of whether we're trying to go for a 20% deduction. Okay, next slide, please. There's also 179. That depreciation has increased also, so we could consider that. Slide 24. Okay, now the 179 has expanded the definition for roofs, heating, fire protection, security systems. If you happen to be doing that, there's something that you could write off in the current year and maybe bring your taxable income down. 25, please. Before I finish, I was going to mention something about cost segregation. Cost segregation, a lot of our clients are doing this, but let me share with you some interesting ideas of where you might do this. Let's say you go into a building that you put in a lot of internal improvements. And if the building had been in service before you did that, you'll find out that under the bonus depreciation, you can get a deduction for it. Now, we have a situation where someone put in the improvements, but it was not just placed in service, it was shell built out. And so therefore, what happens is that bonus depreciation will not apply. It's normal depreciation, but cost seg is a way of where you can split out components of real estate, call them tangible personal property, and take a deduction. So if you have in your building, or if you're leasing and you put the improvements up and you have not done a cost segregation study, I'm not talking about your building, but this would apply to your building also, you might be surprised with the cost segregation study, you could actually get a very large deduction coming through. This could be a strategy, doing a cost segregation study for your leasehold improvements in basically 2018 that you might use for 2018. You can see this is a Rubik's Cube of stuff that you have to really consider. We have all sorts of software we have to actually do this analysis. Our software planning provider actually has already put this into the software modules. So all these different theories that you might come up with is there's an opportunity to run the numbers through. Here's my moral in this whole thing. I would not wait until October to do planning. We typically do end of the year planning on a very robust level, starting around October 16th. What a magic date that's at, or the end of extensions. And we get quite busy during the period of Thanksgiving and forward, and there's only about 6 weeks to really do tax planning. This is more long-term thinking. You know, do I really want to restructure something? Do I want to do this and that? It's not a replacement for the final tax planning, but this thing may cause you to put things in place. So for us, with our clients, what we're doing is, even during tax season, but very heavily right after tax season, we're going to come to conclusions with our clients as to what they need to do to maximize the benefit of what they can get with this new tax law. You don't want to wait till November to say we could have changed our triple net lease to something different, only to find out that you can't retroactively do it because you've already been paying your checks as you went along. So I would call it the new tax law planning strategies really ought to be done by May, so you have them implemented by the end of the year. If you decide to shift things around, if you want to get more magnanimous, remember there's attorneys, there's things that need to be done. It takes time. So that's why I always say make sure that whatever the strategies are, there's a side of saying here's the optimum of what you can do. Let's now see how much of this is real from a business point of view. Slide 26. And there you go. If you have any questions, I want to take a look to see if any came in. I see I just hit my 45-minute mark. So what I'll do is this. If anyone has questions on this, I'll commit to you that if you email them to me, chuck@rcthornton.com, I will respond to them. But if you send them to me by the end of today, I don't want someone to be looking at this on our website 8 months from now and I start getting emails from North Dakota and things like that. So if you have some thoughts, send me an email and I commit to you, I'll get back with you on that. For people who had an opportunity to look at this, but now you have partners or you have other people or maybe even clients that are in this area, this will be on our website and they certainly could look at it, or you could induce the conversation, or you can start talking with your partners on this. So there's another source of information by looking at our website, and handouts will be there. And overall, if we can be of help to you, if we're not already doing so, we would be delighted to have that opportunity. But regardless of which avenues you pursue, I would get cranking on this very quickly and be committed to have your strategies that implement this tax law in place and done by the end of May, and then still do your normal tax plan. But while you're at it, it will probably reduce your estimate payments that you're paying towards your taxes for 2018. Okay, by the way, give honorable mention to Kit here. Kit is the person who, she takes what are very boring slides. I mean, quite frankly, I'm an accountant. I just put bullet points down, and she comes up with all these colors, and she comes up with all these graphs. I mean, this is so nice the work she did. So, Kit, thank you so much. She's the one who's also handling all the, however you work this technology for the webinar. She's the one who figured it out. She's the one that sends out the slides and everything. So I want to thank her, and I'm going to turn this back over to her for wrap up. Kit?
Oh, thank you, Chuck. That was very nice of you. And thank you for this informative presentation. Thanks, everyone, for joining us today. I do want to just mention, if you are interested in sponsoring a webinar at no cost to you for your colleagues or your trade association, please give us a call. We'd love to work with you on your topic. And we have several webinars posted to our website at rcthornton.com. It's on our speaker series page. So thank you so much. Have a great day, everyone, and we'll see you soon.